Hello, hello, hello. It's Stefan Angelini here for another economic update. It's the 21st of February. Today, we're talking about super home deposits, cheap ETFs, the commodity cycle, gold returns, and another super fund merger. So it should be a good episode. If you are out there and you are listening for advice, please don't consider this as personal advice. This is just general information. If you want personal advice, go consult your local financial advisor. We are financial planners, so if you think it's time to rejig your investments or get some financial planning done for yourself, reach out to hello@angeladvisory.com.au and speak to one of our advisors. So with that, let's get into it. What are we talking about today is starting off with super home deposits. Basically, the government has done an inquiry into superannuation and said that the job of superannuation is to preserve savings so that you have a dignified retirement. And everyone can be treated in an equitable and sustainable way. Now, in doing this, they looked at the pandemic early release schemes, and they said that is not good for your retirement savings, and they will not be allowing more early access to superannuation, and that includes accessing super early for home deposits. So, fortunately, that this might upset some of you, but if you are looking to use superannuation to save for retirements, there's still the First Home Super Saver Scheme, which is quite lucrative. You can save some taxes while saving for your first home deposit. So that can be quite good. Getting on to ETFs and cheap ETFs around the world, Beta Shares was the cheapest Australian equities ETF for the top 200. But BlackRock, who's pretty much the world's largest fund manager, has just come in and gone bang and basically dropped their fees by between 44 and 33%. So their ASX 200 ETF has dropped to 0.05%. That's from about 0.1. And their bond ETF has dropped to 0.1% as well. So Vanguard and Beta Shares were the most competitive in these spaces, and now Beta Shares have just come out and gone super cheap in a bid to try and win market share. So they've got a lot of different ETFs on the market, and it is a complex environment now. It used to be simple, but there's a lot of products out there that are called themselves ETFs. But everyone wants a cheap investment, so cheap management fee that is, and that's why they love ETFs. Talking about the commodity cycle, so commodities have been the best performing asset class in the Australian market for the last, say, 2 years. But there's an interesting article on the Inside Advisor basically indicating that after periods of high return for commodities, there are periods of pretty down lows. So over 2022, it was the best performing asset class. It rose 17%. So that's why Australian equities did so well. Direct property was the second best asset class to return 11%, and cash was the third best to return 1%. 15 other major asset classes returned negative figures. Now, importantly, commodities is said here to be binary in nature. So after periods at the very top, there are periods at the very, very bottom. So often late in the cycle, you'll see commodities spike. So if you look back through the 70s, 80s, and 90s, commodities do well in the late cycle, early recessionary periods. So that's what we've just faced, and that's where we are today. There's a really good chart indicating when commodities were the best performing asset class. So let me just reel these off. In 2012 and 2013, they were the best performing asset class. In 2019, 2016, they were the worst performing asset class. So let me do that again. In 2014, they were the worst performing asset class. 2015, the worst performing asset class. 2016, the best performing asset class. 2017, the worst performing. 2018, the best performing. 2019, the worst performing. 2010, the fifth best performing. And then 2021 and 2022, the best performing asset classes. So as you can see, like a yo-yo, up and down. And if you care about what historical returns look like, it may not be a good year for commodity prices or for commodity stocks. So keep that in mind when you are putting together your suggestions for your portfolio. Now let's get on to gold. Gold is often known as a hedge for inflation and volatility. So as markets start to turn worse, gold becomes a little bit better. More importantly, as equities over time has decreased, gold price has increased. So if you look back through 2008 to 2012, markets were in a whole lot of hurt, but the gold price continued to rise, maybe by about 100%, 200%, the gold price rose by, but it hasn't really gone anywhere since the year 2012 because the economy has been quite good. There was a bit of a rise during COVID, but since then it's sort of plateaued. Now, if you look at when it actually does rise, It typically offers a great hedging bet when markets are volatile. But when inflation starts to drop off is when gold starts to kick up. And that's what history shows us. So if you take that on your stride when investing, and if you see inflation starting to come down, maybe gold might be a good allocation for your portfolio. And we certainly know that we've got a lot of managers that are experts in the gold and commodity space who are seeing some great things going forward. Finally, in Australia, we've got a lot of super funds who control a whole lot of money in our economy. And there's even more mergers on the cards. So AV Super tried to merge with Commonwealth Superannuation Corporation. This didn't work, so it fell through. And now Australian Retirement Trust, who were probably, I think, the second biggest super fund, are now looking to merge with AV Super. So if this happens, this will bring Australian Retirement Trust to be very, very close to the biggest with Australian Super. And then again, obviously just a super powerhouse coming through. So that's the end of it today. Thank you very much for listening. It's the 21st of February. Go on, have a great day, and we'll speak to you tomorrow. Cheers. Bye.